will now take up depreciation accounting as to how to account for depreciation in the books of the entity. Before that, we will consider what is the meaning of depreciation, what are depreciable assets, what are the objectives for providing depreciation, what are the factors which go into the measurement of depreciation, and how many different methods of providing depreciation are there, and how profit and loss is accounted for in the books of the entity on disposal or sale of disposable assets, that is depreciable assets. Then what happens when there is a change in the method of depreciation, and finally what happens on revaluation of depreciable assets. In all these cases, we need to find out how to put through the accounting entries. Let us start with the concept of depreciation. So, as we have already discussed in one of the earlier chapters, depreciation is defined as the diminution in the utility or value of an asset due to natural wear and tear, exhaustion of the subject matter, effluxion of time, accident, obsolescence or similar causes. Therefore, there are different reasons for depreciation. It is a decrease in the value on account of different reasons. Some of these reasons are called external reasons, some of the reasons are called internal reasons. So, whatever depreciation is on account of external reasons is known as the external depreciation. For example, depreciation caused by effluxion of time, that is the passage of time, accident, obsolescence, etc. is described as external depreciation, whereas depreciation caused by natural wear and tear is described as internal depreciation, because that is happening because of the use of the asset, that is the natural wear and tear. Depreciation also includes amortization of assets whose useful life is predetermined. Normally, we use three words here. One is called depreciation, the other is called depletion, third is called amortization. All of them are used interchangeably. Normally, depletion is used for wasting assets like mining resources, etc., whereas amortization is used for those assets whose life is predetermined. For example, goodwill, which has to be written off for a certain period, or patent, things like that, where the assets are required to be written off for a certain specific period. Now, let us understand the meaning of depreciable assets. Depreciable assets are those which are expected to be used during more than one accounting period. That means, normally what we call the fixed assets, which are used in the business of the entity for more than one accounting period. That means, they themselves do not get converted to other items, but they are used for either production or for rendering of service, and they always have a limited useful life. They are held by the enterprise for use in production or supply of goods and services. That means, they can be either used in the production of goods and services, or they can be used in the supply of goods and services, or for rental to others, or for administrative purposes. That means, they can even be used for administrative purposes. For example, an air conditioner in the administrative office, or furniture in the administrative office, or they can be rented to others for use. They also are treated as depreciable assets, but these are not goods which are for the purpose of sale in the ordinary course of business. If that item is being sold by the entity in the ordinary course of business, then it becomes a stock in trade, and it will not be treated as a depreciable asset. The objectives for providing depreciation are many. Some of the important ones are: one is correct income measurement. Since the asset is used, certain part of the expenditure needs to be accounted for in the expenditure of that particular accounting period. That only will be able to measure the income of that accounting period. Therefore, for the purpose of correct income measurement, we need to provide for depreciation as an item of expenditure. Secondly, for reflecting the true position statement, that means the assets shown in the balance sheet of the entity have to reflect the correct position. That means, they have to reflect the value of the asset as it is. That means, if the asset has been incorporated in the historical cost basis, if it is already used for an accounting period, the value of the asset has gone down, and that reduction in the value of the asset needs to be incorporated in the balance sheet. So, in order to reflect a true position statement, depreciation needs to be provided for on all the depreciable assets. And the third important objective is funds for replacement. So, as the depreciable assets have a limited useful life, there is need for the entity to replace these assets at the end of the useful life of the asset. Therefore, funds have to be kept separately for replacement of these assets. So, depreciation is a way of keeping separately funds for replacement of the assets at the end of the useful life of the asset. And finally, for ascertainment of the true cost of production. Cost of production, as you know, consists of the cost of materials as well as the expenses incurred in producing that particular item. So, in order to ensure that the cost of production reflects the true cost, we need to incorporate all the expenses incurred in production of that particular item. Therefore, since depreciation also is an item of expenditure, we need to provide for depreciation and show it as an item of expenditure in order to arrive at the true cost of production. And for the purpose of measurement of depreciation, three factors are very important. One is, of course, the cost of the asset, which also includes expenses for its installation, commissioning, trials, etc. And second is the estimated useful life of the asset. That means how long the asset can be used. And third is the estimated scrap value, that is the residual value which you can get from the asset at the end of its useful life if it is sold in the market. That is called the estimated scrap value, or also known as the estimated residual value. This is the value at the end of the useful life of the asset. So, the depreciation is computed in the following manner. The amount of depreciation is always equal to the depreciable amount divided by the estimated useful life. And depreciable amount is given by the equation, the historical cost or the other amount substituted for historical cost less the estimated residual value. For example, if the residual value of an asset is say 1000 rupees, and if the asset has been acquired for 1 lakh rupees, then the depreciable amount of the depreciable asset is 1 lakh rupees minus 1000, that is 99,000. So, the amount of depreciation will be 99,000 divided by estimated useful life. Let us assume that the estimated useful life of the asset is 10 years, in which case the amount of depreciation will be 99,000 divided by 10, that will be 9,900 rupees. That is how the depreciation is calculated. And for calculation of depreciation, there are different methods. Two of the most important methods are, one is called the straight line method, also known as the SLM. Second is called the written down value method, called the WDV method, also known as the reducing balance method. In the case of income tax rules prescribe WDV method for accounting for depreciation, except in cases of undertakings engaged in the generation and distribution of power. In all other cases, they are required to follow the WDV method. But Companies Act does not prescribe any such rules. That means each entity is free to follow whatever method best suits the entity. And since the income tax rules prescribe WDV method, by and large most of the entities follow the WDV method. Let us understand each of these methods and then go to some of the other methods which are also used by some of the entities. So, let us start with the straight line method. An equal amount is written off every year during the useful life of an asset, so as to reduce the cost of the asset to 0 or its residual value at the end of its useful life. That means ultimately, after providing for depreciation for the useful life of the asset, the value will be reduced to the residual value or the scrap value, or if the scrap value is 0, the value will be reduced to 0. Therefore, in terms of the SLM, the amount of depreciation is given by cost of asset minus residual value divided by the estimated useful life. So, the depreciation rate in this case will be depreciation into 100 divided by the cost of asset. To illustrate with an example, let the cost of asset be 1,10,000, let the residual value be 10,000 and let the estimated useful life be 5 years, in which case amount of depreciation will be 1,10,000 minus 10,000 divided by 5 years. So, it comes to 20,000 rupees. So, the depreciation rate will be depreciation into 100 divided by cost of asset, that is 20,000 into 100 divided by 1,10,000, that will become the rate of depreciation of the asset. In the case of WDV method, a fixed percentage of the diminishing value of the asset is written off each year so as to reduce the asset to its residual value at the end of its useful life. The idea is to again bring down the value to its residual value at the end of its useful life. So, in this case, depreciation rate is always calculated on the basis of the formula given as 1 minus nth root of residual value into 100 divided by the cost of the assets. So, here what happens is that rate is first applied on the value of the asset, and in the next year the rate will be again applied on the reduced value. That means the amount of depreciation calculated keeps diminishing every year. That is why it is called the diminishing balance method or the reduced balance method. There are a number of other methods also used in calculation of depreciation. Some of them are, one is called the sum of years of digits method, second is called the annuity method, third is called the sinking fund method, fourth is called the machine hour method, fifth is called the production units method, and finally we have the depletion method. These are the different methods which are used in calculating depreciation. And to illustrate the sum of years of digits method, this can be illustrated with the following example. Let the cost of rupees 1 lakh and the useful life of the asset be 5 years. So, in this case, sum of the 5 years digits will be, we have to add all the years 1 plus 2 plus 3 plus 4 plus 5, which will become equal to 15. So, the first year depreciation will always be 5 by 15 into 1 lakh, second year will be 4 by 15 into 1 lakh, third year will be 3 by 15 into 1 lakh, and so on. This is how the sum of years of digits method is calculated. As you can have a look at that, the value of depreciation in the first year will be higher and it will keep on going down progressively. That means it is almost similar to the WDV method, because the depreciation amount is higher in the initial year and goes on reducing in the later years. And in the respect of disposal or sale of depreciable assets, there may be a profit or there could be a loss. This also has to be accounted for. So, in this case, it is charged for the period for which it is used during the year. So, depreciation has to be charged for the period it is used during the year, and profit is loss is computed using the written down value method. Such profit or loss is transferred to the P&L account. If it is a profit, it is credited to the P&L account. If it is a loss, it is debited to the P&L account. And if there is any change in the method of depreciation in terms of the accounting standards, they are required to be disclosed properly. So, what the accounting standard says is, the method selected must be applied consistently from period to period. That means there should be some kind of consistency in applying the method of depreciation, and the method can be changed only under certain circumstances. So, the accounting standard says a change in the method is made only if the adoption of the method is required by law. If suppose the statute is changed and as per the new statute it is required to be followed, then the entity can change the method to follow the method which is laid down by the law, or for compliance with the accounting standard. So, a new accounting standard may come into picture and that accounting standard may prescribe a particular method, and if the entity is following a different method, then that entity can change to the method as required by the accounting standard in order to comply with the provisions of the accounting standard. Or the third reason is, even without the first two, it can still be changed if the entity thinks that the method changed will result in a more appropriate preparation and presentation of the financial statements. Because of the changed scenario, the new method may be more appropriate, in which case the entity can change the method of depreciation. So, if there is any change in the method of depreciation, then the depreciation has to be calculated from the date the asset is been purchased. That means from the first date all the calculations have to be made, and any deficiency or surplus has to be debited or credited to the P&L account, and in order to ensure that the users of the financial statements come to know of the change in the method of depreciation, they need to be disclosed properly. Not only the fact that the method has been changed, but also the quantum of extra depreciation charged or not charged has to be disclosed in the financial statements. And if the depreciable assets are revalued, then the useful life of the asset also is recalculated, and the depreciation is calculated on such readjusted value of the asset depending on the readjusted useful life of the asset. Now we will come to the accounting entries which are required to be passed in the books of the entity for providing depreciation. So first entry of course will be depreciation account debit and the concerned asset account is credited. That means depreciation is treated as an expenditure, so that account is debited, and the asset account, the balance is reduced. So the debit balance goes down by crediting the asset account with the appropriate amount of depreciation. And if provision has to be created, then you can again debit the depreciation account and create it as a provision for depreciation account, in which case the asset balance will not go down. There will be a separate account opened known as the provision for depreciation account. So now let us try to understand these entries with the help of an illustration. Let us start with the straight line method, how this is done. This is the example. ABC acquires an asset on 1/10/2008 at a cost of rupees 1 lakh. It writes off depreciation at the rate of 10% on the straight line method. The books are closed on 31st March of every year. Show the depreciation entries for the first 3 years. So as you can see on the board, the first year entry will be as on 31st March 2009, and since the asset has been bought on 1/10/2008, depreciation has to be provided only for 6 months. So the rule here is, if any asset is bought before 1/10 of that year, then full depreciation can be taken even if the asset is not used for the full year. But if the asset is bought in the second half of the year, that is 1/10 or afterwards, then depreciation has to be provided on a pro rata basis only for 6 months. So in this case, since the asset has been bought on 1/10/2008, depreciation is being provided only for 6 months. So the actual depreciation will work out to 10,000. So only half of it is taken. So we are debiting depreciation account with 5,000 and the asset account is credited with 5,000. In the next year, of course, since we are following the straight line method, the amount will be same in the second and third years. The amount will be 10,000 rupees. So depreciation account is debited with 10,000 and the asset account is credited with 10,000, both in the second and third years. That is as on 31st March 2010 as well as 31st March 2011. In the case of a WDV method, we will take the same example. Instead of the asset being bought on 1/10, we have now taken it as 1/6/2008. The cost remains the same. Depreciation rate is 10% on WDV method. The books are closed on 31st March. So we have to show the entries for 3 years. So as you look at the screen, the first year, of course, since the asset is bought in June, we have to provide for full depreciation, that is for the entire year. That means the asset has been used for more than 6 months. So we have to provide for the entire year. And since the rate of depreciation is 10%, 10% of 1 lakh works out to 10,000. So the first entry will be depreciation account debit with 10,000 and the concerned asset account is credited with 10,000. In the second year, again we have to calculate depreciation. Because it is a WDV method, the written down value of the asset after the first year will be 1 lakh minus 10,000, that is 90,000. So in the second year we have to provide depreciation at 10% on 90,000, which works out to 9,000 rupees. And in the third year, the WDV value of the asset will be 90,000 minus 9,000, that is 81,000. So for the third year, we have to provide depreciation at the rate of 10% on 81,000. So the entry will be depreciation account debit 8,100, credit the concerned asset account with 8,100. And in the case of a sinking fund method, also we are required to pass different entries. So first let us understand what is the meaning of sinking fund method, then we will go to the entry is to be passed in respect of sinking fund method account. As we have seen in the case of SLM and WDV method, there is no provision made for replacement of the asset. That means this money is not kept separately. It is treated as part of the overall profit and loss account. And therefore, when the asset is to be replaced at the end of the useful life of the asset, ready cash may not be available to the entity. Therefore, it makes sense to keep aside the sum which is taken as depreciation and invest it in some readily sellable securities, so that when the asset needs to be replaced, all these securities can be sold off and the old asset also can be sold off, and whatever money is received on account of this, we can use that money for purchasing a new asset. That means replacement becomes easy. Such a system of keeping funds separately is known as the sinking fund method. So in this case, we need to find out how to pass the entries. So here these entries are divided into different periods. One is how to pass an entry at the end of the first year, then during the subsequent years, then how to pass entries at the end of the useful life of the asset, when the asset has to be sold and the security is encashed and a new asset purchased, that is new asset is purchased to replace the old asset. Let us start with the entries to be put through at the end of the first year. So there you can see depreciation account is debited with the amount of depreciation calculated on the method. That depreciation amount could be by any of the methods. It can be either on a straight line or a WDV method, but that amount is debited to the depreciation account and a sinking fund account is credited. That is the depreciation provided for the asset during the year, and a similar amount is now kept separately as a sinking fund investment account by debiting that account and crediting the bank account. That means bank account is credited, that means that amount is taken out and kept separately in the form of a sinking fund investment account. This is the amount invested in securities. That means the depreciation whatever is calculated is invested separately, so that it is not used for any other purpose by the entity. And at the end of the second year and subsequent years, we have to similarly pass entries. In the second year, what happens? We will again pass the two entries, that is depreciation account and sinking fund account, and also transfer to sinking fund investment account by crediting the bank account. But the only difference here, as you notice in the second transaction, is that in addition to whatever depreciation is calculated for the second year, whatever interest has been earned on the securities invested in the first year is also transferred to the sinking fund investment account, and the bank account is debited, and the interest on sinking fund account is credited. And finally, interest on sinking fund account is debited and sinking fund account is credited. That is, the interest on the sinking fund investment account is transferred to the sinking fund. That is done at the end of second year and subsequently in the next year, that is third year onwards, until the useful life of the asset. That means whatever interest accumulates is again brought back to the investment account and again invested into the securities. And finally, when we have to replace the asset at the end of the useful life of the asset, that time whatever money is there in the sinking fund investment account has to be encashed, and similarly the old asset also has to be sold and money brought in. So in order to get the money back, what we have to do is sinking fund investment account is credited and the bank account is debited with the amount of sale proceeds of the sale of investments. Whatever money has been received by selling those investments will go to the bank account. That means there will be extra balance available in the bank account to take care of that. Similarly, you look at the second entry, that is sinking fund investment account is debited, sinking fund account is credited. This is the profit on sale of investment. Whatever profit is there, it is taken to the sinking fund account because that becomes an item of income. Similarly, any loss is also adjusted. That will be just the opposite of the second entry. Instead of crediting sinking fund account, we are debiting sinking fund account and sinking fund investment account is credited. And lastly, we have the depreciation account debit and sinking fund account credit being the depreciation for the last year. And in addition to that, we have also sold off the old asset. So what we have to do is sinking fund account is debited with the amount received on account of the sale of the asset, and the concerned asset account is credited. That means that asset account is closed. That means the old asset has been disposed of. Now what is left is a balance in the sinking fund account. Whatever is left is debited and it is credited to asset account. And finally, we have to buy the new asset in replacement for the old asset. For that, we have to debit the new asset account and credit the bank account being the purchase of a new asset. This is how entry is passed on the last year when the asset needs to be replaced.